Welcome to the Strategy Asset Managers Market Update Call, November 16th, 2022. You should all know that we have been going through a kind of a chaotic period for me because my father, Carl, is in the last stages of palliative care. And he was very instrumental to the founding of the firm. He's 87, and my prayers go out to my father today, as this will be a call in memoriam to my father, who may be passing away in the next couple of days. And a great segue also to introduce, and then at a later time, Adam Britton, Dr. Adam Britton, and also he's with World Clinic, and Dr. Bill Lang, who will be on our call today. We also have a guest, Michael Williams, formerly with Ernst & Young. He's a nationally recognized tax planning attorney. But to start out, we will have Joe Traba, Alex Hagstrom, and myself give an update on what's happening with the current market environment, what happened with the elections and what to expect there. We are going to talk about year-end tax planning with Michael Williams, and some of the advanced planning and concierge medicine ideas that may be a benefit to you. But now that the elections are almost over, we have a clear understanding of what the path will be leading into the second half of the electoral cycle. So I'm going to turn it over to Joe Traba, and Joe and I are going to go back and forth and talk about it amongst you all. Okay, Joe?
Thank you, Tom. So before we begin, we always kind of like to go, where were we? And if we look back in September, pessimism was at all-time highs, and the expectations were that the markets were just going to keep heading lower. Interest rates were going to keep heading higher. Inflation, there was no end in sight, and we had geopolitical unrest. And what we had said is that when you see pessimism this high, there are reasons to be optimistic. And we fast forward and look at what happened in October. A lot of the negative sentiment that was priced in for the market to be in a full-blown recession did not materialize. We are starting to see inflation cool, and the midterm elections did come, and we did not see a change in policy, but we did see a number of Democrat states that held on. And again, for us, it was just not seeing a huge wave with increase in spending, and also with the Biden agenda. And we'll go into that in a little bit of detail. Also, when you look at the calendar, typically the third year of a president is the strongest period for the market. It averages about a 14.5% gain since 1950. And it's also the fourth quarter, of this year. And the first 2 quarters of next year are also a strong period. And that has a lot to do during midterm elections, because what we typically see is gridlock. And why is gridlock good for the stock market? Because we just said that you don't see, you see a divided government between the White House and Congress. And again, that does not see higher taxes going up, nor more spending going on. We'll go into a little bit more detail, Alex will, in a little bit on that. But before we begin, we also want to know, how are we positioned heading into 2023, and some of the things that we can do at the end of this year. So what we know for a fact is that we are in a slowing economy. What happens in a slowing economy? People are going to be spending less. Now, inflation will be cooling off, but we also know interest rates are at a level that we have not seen in several years. That allows savers to actually have a fixed rate of return. And we are now seeing money markets yielding over 3%. You can now get fixed income that's yielding close to 5%. This was not available just a few months ago. So with higher interest rates, that's the positive for savers. The negative is that you're going to see higher borrowing costs. And we just saw credit card debt was up almost 15% year over year. So with that, you're going to see more stress on lending, and that is not a positive catalyst. But there are, like we said back in October, with people being employed, wages going up, those are positive. Now, as we enter next year, we're starting to see large tech companies doing some severe layoffs. And again, that's a function of where we're at in the cycle. So things that we do like are companies that have pricing power. And you really think about that when you go to the pump, you need to get gasoline. So we still are positive on energy, healthcare. And again, it's going to be some of the industrial companies. And why industrials? Well, if you start seeing inflation go lower, their input costs go lower and they can actually make a better profit. So just some things that we do like. And again, some things that we're more light on, it's consumer discretionary. And this makes sense with less spending. You'll actually start seeing some of these companies, again, just what we've seen in the past with the pandemic, that starts to slow down. And you also see businesses not spending as much. And that means you'll start seeing some of more in-house and less spending to other services. So just a few things to keep in mind as we head into 2023. Like we said, for this year, we did expect more volatility, not to the extent that we have seen this year, but it's, again, unprecedented events that have happened this year that are playing out on a historical basis. So we don't expect history to repeat itself, but it often does rhyme. Now, one of the big points we talked about was inflation. And Alex has some very good points to share with us.
Yeah, so we did recently get some very encouraging inflation data. Inflation in October fell for the fourth consecutive month on a year-over-year basis. Inflation peaked in June at around 9.1. The most recent reading was 7.7. So long as oil prices remain near where they are, June will have been the inflation peak for this cycle. The leading indicators of inflation are very encouraging in terms of pointing towards inflation rates continuing to decelerate, though I would caution people to not overestimate how fast this will be, especially with respect to shelter, which tends to lag home prices by 1 year. That aside, it's very good to see the natural process of capitalism, of supply and demand start to work on prices, especially when you look at shipping rates, commodity prices, goods prices, even car prices. We're seeing the unnatural spike that was caused by the government's COVID response start to reverse. I know that the media operates on very, very short timeframes. They want everything to happen in a couple of weeks or a couple of months. Unfortunately, the economy doesn't adjust at that speed. Nonetheless, things are clearly moving in the right direction on the inflation front. We can see in many areas that the US economy is still functioning as it should, that the economy is recovering from the inflation spike and will continue to recover. Inflation will eventually normalize, rates will eventually normalize, we'll eventually put this whole unfortunate pandemic episode behind us. And I think one silver lining from the experience is that policymakers are going to learn that you can't spend infinite money, you can't print infinite money, you can't run infinite deficits, and that seems obvious. But if you go back to 2019, you'll see a lot of academics and politicians in favor of extremely massive deficit spending. That's exactly what they did when COVID struck. I think the really terrible inflationary consequences of those policies has really taught a lesson to the people in our government. You can expect that budget deficits will be much tamer over the next few years. And that's a really good thing for the long-term health of our economy.
And that's a really good, important topic when we talk about what's going to happen with interest rates. So what the Fed tries to do is raise interest rates to where inflation is. So now we start seeing inflation cool off. It allows interest rates to not go up at the same clip that we've been seeing. And if you look at where interest rates can go, we are now seeing potentially an 80% chance of a 50 basis point hike in December. And then that slows down in 2023, where potentially we see 25 or 50 basis points hike through the first quarter of 2023. So we are starting to see inflation cool, and we can see a potential end in these big interest rate hikes. That is the purpose of what the Fed's trying to do, is slow the economy and get inflation lower. We can have a debate on that or not, but this is the facts that are happening. And we are starting to see, again, the economy slow down. And another topic they look at are jobs. And as we've mentioned, you've heard a lot of job layoffs recently in the last couple of weeks. And that kind of goes in with less spending. And we can see that on the business cycle with advertising. So advertising has been lower. And again, you got to look at the cycle. 2 years ago, you had a ramp up in spending for online ads, and now people out and about. So you do see a decrease in revenue for advertising online as people are more and more out and about. And that's a good thing. But again, it's positioning ourselves going forward.
Joe, Alex, thanks very much for the commentary. I've got a couple of questions that have come up. One, we know that we're heading into a very tough time into 2023, and whether the recession is officially announced or not, it's definitely there. The economy is slowing down rapidly, and with the midterm elections over, and the fear of a majority on one side or the other, and shifts in policy probably not happening, rates rising at the fastest pace they've done historically. What does that mean for 2023 for our portfolios at Strategy Asset Managers? How are you positioning our clients, both institutional and private clients, for success in 2023?
And that's a great topic, because we have two things to look at. One, you actually have now a fixed income alternative getting 4 to 5%. And you also are seeing the US dollar, which has been the kingpin for safety. Money's been pouring into the United States because how strong the dollar and safety's been. And what we've just started to see is potentially not as strong, and you're seeing other assets go up. This could help the international side. And again, a dollar just not as strong as it was last year, just subsiding. That's going to help the international side. So I would look for a little bit better performance on the international side. And again, a safe haven like gold, that's actually doing fairly well here. But another important topic is some things that we do not own. And that's really exploded with cryptocurrency. And this is something that we've not been invested in. And when you see $1 billion company go down to declaring bankruptcy, these are, you are seeing contagion effects of lost money that might have been on paper, but nevertheless, it's gone out of people's assets. So that does have some lingering effects where you can't sell what you want to, you got to sell what you own. So again, with the whole cryptocurrency, the devaluation there, that as a lost asset class, and I think you'll see some more negative headlines on it. For us, we like regulated markets because I know who's buying and selling. And that got us very nervous with the crypto because I don't know who's buying and selling, and price discovery is not available. So again, certain things like that I think give us more optimism in how our markets operate. It's obviously on the bad times more importantly, but also on the good times. So that's just a few things, how we're positioned. And again, liking companies that can raise prices. And again, things that are more durable that we'll need to have, and less on things that would be nice to have. So a slowdown in the economic cycle. This is what we've seen historically and how we're positioning for next year. So I do think you can see, again, with energy, but also with some of the international actually having more positive developments. And that's really on twofold. One, China has been shut down. And we're starting to see more signs of them opening up, not just with travel, but also with the global supply disruptions. As they get more online, that helps both inflation go lower, but it also helps travel for people leaving mainland China and their spending. So you kind of think of the United States after 2 years or so of being locked down, we had this huge wave of going out. China is now on the third year, and you are seeing a lot of pushback that I think that could be a positive catalyst. And also, if we get some stability in Ukraine and Europe, that'll help the deflationary pressure there. And again, it's spending. So a few
Joe,
things.
I want to cut you off and ask Alex to comment on the international markets as well, and what the opportunities are with worldwide equity in our in some of the non-specific moves that we've made, but we've been increasing energy, increasing our energy allocation. We've been increasing our healthcare allocation.
Yeah, and I think, I think with respect to foreign stocks, it's really an area where it's essential to have an active manager, and you don't want to just buy the index. Because if you look at these indices, the European index, the Chinese index, they basically are at the same level that they were in 2007. So you need someone to really pick out the stocks, and there are stocks to pick. These are, structurally much cheaper markets, but you've really got to pick your shots correctly to find the companies that do have that secular growth.
Okay, Joe, we've got a pretty broad audience. We have guests on from Europe, and I would like to talk a little bit about the geopolitical activity that's out there that's stressing out. And Alex, and you've made a couple of points about the what ifs. What if we do see Russia tone down the aggression in Ukraine? What would that mean for the markets, Alex?
Yeah, I think, basically the war has had this effect of delaying the normalization of inflation, right? We had this inflation spike as a result of COVID. As that was starting to ease, we had this war pop up and we had the increase in oil prices. So it sort of pushed back the timetable. And I do think, if the war were to escalate, significantly further, that would also sort of delay inflation going back down to normal just as a result of oil prices high. But, Russia is a commodity producer. That's its only impact on the global economy. So outside of commodities, we're okay. But yeah, especially specific commodities as well, it could really cause prices to spike.
Thanks. And Joe, let's talk a little bit more about kind of forward-looking. The markets are forward-looking. And what are you seeing right now with 2023 and the potential for the markets to stabilize? And when would we see some hope of stability? You did say earlier this year that as the markets were bottoming, and the indices were down between 20 and 30%, that we should end the year in a much more positive pricing area, which we have. Would you touch base on where we were and where we are now, and then also what you see in the first quarter and second quarter?
Yeah, and so when we look at where we were in September, the pessimism, and this is just looking at a number of indicators that we saw, everything was priced for the stock market to just continue to head lower. We were at levels that were in 2008. And if you look at all of these lower levels, this is more technically, that's where sentiment was. And when we looked at the actual economy, you had strong growth in jobs. You do not get a severe recession when you have jobs increasing. So that was our main factor, but we also saw the consumer was still spending. And those were, again, when you look at cycles, that's very robust. And I think the worst case scenario was priced into the market and we didn't get it. And we are getting some positive announcements. Now, that kind of still goes forward for this year, because I do think there's still a very healthy skepticism out there. And we also know companies are doing buybacks. So there are buyers out there. And I do think as we get into the seasonally strong period, and there are going to be people taking vacations, which deservedly so, you could see this market kind of melt up. We are going to see the inflation data cool off, which gives us some ease with the interest rates and kind of sets us up for next year, maybe to follow suit in the first half of the year with some nice returns. But we have to see the effect of interest rates and how that affects the economy. So I do think we overshot to the downside in 2022. And next side, you could see the markets, definitely head higher. But again, we're going to have volatility because a lot of these issues we spoke about are not resolved, and interest rates are going to hurt spending, as we've seen with credit card debt. And that goes through housing. It goes through people buying cars. This has a delayed effect, but we should see rent prices go lower. And I think the best thing that we can take away as a consumer, you should see a lot of sales for this year as we head into Christmas. Tom?
Sorry, I was on mute. And Alex, do you have a comment on rates right now? I'm interested in what Strategy Asset Managers has been doing and also projecting out to our clients with the opportunities in the treasury market, corporates, and elsewhere in fixed income.
Yeah, there's, a lot of opportunity to earn, yields 4% or above and lock those in for, 3, 4, 5 years. And that's what we've been doing in a lot of accounts. And what that does is even if, rates end up being cut, a year or two from now, you still locked in that really high yield. In addition to that, you're not going to lose money if rates keep rising. You'll be fine on that front as well. So yeah, a lot of great opportunities in the treasury market and very high grade corporate bonds as well.
So the cash positions that we held have benefited clients once the fixed income that was in a portfolio matured. We've now been able to trade up into an equally as high quality position at a much higher rate, correct?
Yes,
Yeah.
that's the money markets. Now we have to buy a money market fund. And this is just because the custodians are a profit center. That's how they make money on cash. But we're now getting, north of 3%, some as high as, 3.7%. So again, that's something that's great for savers.
Right. So, for those of you who are on the call, I'm sure that you're aware, any cash outside of the existing accounts that are being managed, you should probably ask the question: are you positioned in the right money market fund or fixed income instrument to maximize the interest that you're earning on your cash that's out there? So that's the message there. Let's roll into kind of a summary of what's there, Joe. I would like for you to just retouch again on the areas that should benefit more in 2023, such as energy, healthcare. Talk sector specific, if you would.
Yeah, first off, again, we don't think the volatility will end, so that will be in place. But you do have, like Tom mentioned, a cash alternative or fixed income alternative, and that's because of where interest rates are at. And we are, again, seeing some encouraging news that is helping. and that's market will be driven short term by sentiment. And we always go back to long term earnings are driven by, that's what drives the markets on a long term basis. And we are still seeing earnings grow. It's going to be low single digits for 2022. And so far, the expectations is for slow growth, but growth in 2023. And I think that's the catalyst that you have to look at when you look at the stock market. And then, like Tom said, positioning is very key. Being in the overall indices That was very skewed toward the large tech companies, and that has definitely hurt performance if you were overweight those places. Also international, like Alex mentioned, most of the international benchmarks are usually around a third, 30% invested in financials. We think they're better places to be than just the financials right now. So it's active management and being to go into different sectors, like Tom mentioned. And I'd also think some of the industrials, because commodity prices are going lower, and you still see production going. And again, people going back to the hospital for delayed services that they might have done, that's beneficial. And these are companies that have pricing power. So that's where we think the shift will continue. And again, the consumer has been resilient, but with the increase in borrowing costs, that's going to hurt both businesses and the consumer. So a kind of tightening of the belt there, but that might be more in the second half of 2023.
Alex, any comment as a follow-up?
Yeah, just, even if there is a recession, it's important to understand that recessions in America aren't the end of the world. In fact, the history of America has been that those have been opportunities, right? Great opportunities to buy in at low prices and make a lot of money, because the long-term trend has been upwards for 100 years. So when you get, short-term sell-offs driven by cyclical economic activity, they tend to be a good place to position for the recovery, which has been inevitable again over the last century or so.
Right. Well, Strategy Asset Managers has really given some good advice this year to all of our clients, and we're pleased with the direction of the performance in the portfolios. And Bob DeMichael's on the call, former owner and also a very well-known portfolio manager. He has been instrumental in always participating and supporting the group, but along the way he set the tone for active management in the value sector, and that has not only served him personally well, but the legacy of the company for strategy clients. So thanks for being on the call today, Bob, as a shout out to you. I do want to say, before I transition over to the World Clinic, Dr. Bill Lang and Dr. Adam Britton, that I was at the Schwab conference a couple weeks ago, and Mario Gabelli was at the conference. He's a longtime value investor, but in somebody that you may have seen on CNBC or Fox or any of the news channels. And I went up to say hi to him. I introduced my firm, and he said, "That's Bob DeMichael's firm." And I said, "You're right, it is." And reputations go way back, and Strategy Asset Managers has that reputation of being one of the best money managers out there, as well as providing strong advice to their clients, and especially in good times, but also in very challenging times. And that's where the active management comes in. So it's nice to have people out there recognize the legacy and the history of the firm, as well as the strong leadership that goes alongside with that. I would like to introduce two people who are important to the firm and also to you out there. One of them is Dr. Bill Lang, who's the Chief Medical Officer at World Clinic, along with Dr. Adam Britton, who's a senior physician at World Clinic. I was introduced to World Clinic through another source. They are an expert in concierge medicine. Is that something that you should consider out there? Well, it is when you don't have a doctor in the family that you can call upon, or you don't have somebody who's an advocate for you in some of these challenging times, when you're trying to interpret medical data as we get older, or we have a loved one in a position that needs extra assistance. We offer this as kind of a concierge service to our clients, and it may be something for you to consider out there. Let me give you a little bit of Dr. Bill Lang's background. He's been a family physician for over 30 years and recognized as a foremost expert in health aspects of contingency planning and response to critical incidents. As a director of the White House Medical Unit and deputy physician to the president, Dr. Lang was responsible for organizing and providing comprehensive healthcare services to 2 U.S. presidents and their executive staffs. Later, as an associate chief medical officer of the Department of Homeland Security, Dr. Lang played a key role in the department's implementation of the nation's preparedness strategy. Simultaneously, he was often the on-call physician for senior leadership, responding to all health issues that arose. He's been an assistant professor of family medicine at both Uniformed Service University and UNC, and also is the section author for Healthcare Abroad in Travel Medicine. I'm also going to introduce Dr. Adam Britton right now, who's also a senior physician at World Clinic. Dr. Britton is an internal medicine physician at Texas Medical Center, serves as a hospitalist with the Medical Center Hospitalists Association. He's trained in surgery, internal medicine, and is board certified by the American Board of Internal Medicine, and as a member of the American College of Physicians and the American Medical Association. He's also an internal medicine physician that treats, I guess especially he's well trained in the diagnosis of puzzling medical problems, the treatment of acutely ill and critically ill patients, in the ongoing care of chronic illnesses, and in the caring for patients with more than one disease. Let me welcome Dr. Bill Lang and Dr. Adam Britton to the call. I'm going to say that Dr. Bill Lang is going to open up, and as Adam told me, he's going to add color commentary to the discussion. Bill, you there?
Yeah, so I'm Al Michaels of the group, and Adam's going to be our Chris Collinsworth. But I'm sure a lot of you are sitting there saying, "Wait, this is a financial update. Why do we have a couple of docs talking to us?" Well, I had a Series 7 for over 20 years, and I learned that the clients, so often they get to trust their financial advisors, their asset managers so much that they start asking them, hey, I've got a healthcare issue. Where do you think I should go? So that it tends to come up. And I think what we're seeing is that our healthcare system is increasingly broken, and people, especially people that have assets, are looking for alternatives, are looking for just help in where do you go to get care? It's what we're seeing is accessing healthcare today is just incredibly difficult. And then the other thing that's happening is that the general clinicians, even highly respected specialists, have become cogs in big corporatized healthcare. So, as you're trying to deal with that for yourselves and also for your clients, what you really start needing is a quarterback. And that's what, to me, the right kind of concierge healthcare is not just a super internist, which as most concierge docs are. It is a quarterback for your care that builds the team on the fly that you need. And so I don't want to go. I could just keep talking forever, but I thought that maybe it might be good to answer some questions. Or Tom.
Yeah. So what we'll do is the reason we brought Bill and Adam on, Dr. Britton, Adam Britton, and Dr. Bill Lang on the phone is one. In the last 6 months, I have been an advocate and a quarterback for my father, Carl, in declining physical condition. And it would have been very helpful at the time to have a doctor in the family, of which we didn't. And then I turned to the World Clinic for guidance on this, which really improved the quality care that was out there. This is something that is important in the future of medicine as we evolve into teledoc calls, but also in interpreting incredibly advanced data that is in front of us to help us live longer, healthy lives. Maybe Adam can come in at this point and talk a little bit about that, and then we'll ask some more questions. Adam, you with us, off of mute?
Yeah. Yeah, great. Thank you so much, Tom, for having us. This has been terrific and quite a learning. So this is so much, this type of information for doctors is so far over our heads. It's great to get some experienced anecdotes for the market. But yeah, no, we really enjoy being the quarterback and the doc and the family. And, I use this example a lot. We had a patient recently with some disturbing news from a PET scan. And again, very complicated medical information that needs to be interpreted. And a lot of folks, especially our members and patients, want to know right away. They want to get in right away. And time is money, as you well know. And taking that prospective look into how do we circumvent some of these issues in medicine and get you to the person you need to get to right away. So we interpreted the data, we explained the data to the patient first and foremost, which is most important. And then you go the next step and you help set that patient up with who he needs to see. And he was in to see a cancer specialist and a CT surgeon within 48 hours at Dana-Farber. So our contacts are all over. We've got, we can get people in anywhere, anytime, and it just makes the decisions easier when you have someone guiding you along the way and helping you and being the quarterback and being the gatekeeper, so to speak, and helping to facilitate some of these things that are very confusing. And like Bill said, it's impossible to get a hold of a doctor these days, even especially specialists. I mean, you call in for an appointment and you're waiting months and months to get in. And if you got a pressing issue that needs to be looked at, that can be quite distressing. So, we kind of help in that way. Time is money. We take the lead in terms of taking control of the situation, interpreting it, getting you to where you need to go. If you don't need to go somewhere, we're able to help you with the seeing it through to resolution. And so that's kind of where we come in. But really, we really enjoy that role because we establish these relationships with the patients, and that's really what matters to us in doing what we do at World Clinic.
Great. Bill, do you have any follow-up on that as well?
Yeah, I think that, and tying it back to financial services, I think that and as you're going through the presentations earlier, you're talking about value and how you really look at value. Well, that's what we do when we're looking at how you deliver healthcare. It's not about delivering the cheapest healthcare. It's about, or even leading patients through things just to, so they can get to anybody. What we want to deliver is, I call it the Ben Graham approach to healthcare. It's how do you deliver value, and what do people value? They value outcomes, they value efficiency, they value responsiveness, understanding. They want to understand what they're being told. That's often difficult in medicine. They want guidance, and lastly, they want a system that values their time. Because especially for the kinds of people that we're talking about, time is incredibly valuable, and it's worth much more than whatever they're stroking on the check to pay their insurance or their additional fees. And so if we can help people understand what's going on with their healthcare and use it effectively, efficiently, and save them time, that's what adds value to it. And that's kind of our mission at World Clinic, is to be able to give people efficient use of their time so that they have the health that they need and the value that they need to be able to pursue their life goals.
Right.
Sure.
And that's a great point, Bill. And our folks, as you can imagine, Tom, talk about and ask us about longevity. Well, longevity to a lot of people just means chronological age. To me, I made this analogy at the CEG. It's about living healthier longer, being productive longer. I'd much rather be 85 fly fishing on the Madison up in Montana than 95 or 100 and laying up in a nursing home. So it's all about quality of life, and that's why we take that prospective look into healthcare, looking into preventative cardiovascular disease? Are there any tests we can do to prevent certain types of cancers? So taking that prospective look and staying ahead of the 8 ball, and you guys know that well, in the markets, taking a proactive look at the markets for your clients. That's the same type of thing in medicine. You stay ahead of the 8 ball, you stay ahead of the curve, you're going to be in good shape, and you're going to do well for your clients or your patients.
Sure. Does insurance cover this, Adam, Bill?
Well, Bill, go ahead.
No, insurance does not cover. Insurance is the way the insurance system works today. It covers very specific codes. What did you do? Did you sit with the patient? Did you do a procedure? Did you sit with the patient for a certain length of time? That's all insurance covers. What we're providing is two things. One is we answer the damn phone in order to answer your questions and needs.
Right.
And the second is we provide I don't want to call it concierge medicine. We provide the medical concierge, the person who is going to help you access those services that you need without you having to sit through phone trees and gatekeepers and secretaries and what have you.
And that's overwhelming. That is
Yep,
very overwhelming,
exactly.
especially when you're in critical.
And Tom, once we make that referral, once we make that order for the MRI, whatever the case may be, that is covered by insurance. So, and a lot of times we'll have to do peer-to-peers, or we'll have to do insurance approvals, which is easy for us to do. Although our service is not covered by insurance, once we refer you out to a specialist, say at Dana-Farber or whatever, those services usually are covered. So it's an extension of what we do that usually is covered by insurance.
Yeah, that's great. I want to direct everybody to worldclinic.com, which are Dr. Bill Lang's and Dr. Adams Britton's website for additional information. We will have a follow-up webinar later in December with more information on World Clinic. At this point, I want to transition over. First of all, thank Dr. Bill Lang and Dr. Adam Britton for being on the call. This is something that's important to you out there in the audience to know about and also to consider. But if you would like to have a follow-up conversation with us through your advisor or directly, please feel free to reach out. I know this is something that has helped me and my family. It's helped the employees of Strategy Asset Managers, and it's always good to have a resource like World Clinic in your back pocket, especially as things as we age. So thank you very much, Bill and Adam.
Thank you, Tom.
You're
Thanks for
very
having us.
welcome. Yep, you're welcome. And I'm now going to introduce Michael Williams. And Michael Williams is an attorney, is a tax expert in the field of tax credits and tax planning. Why is Michael on the call with us today? Well, he also presented at one of the leadership conferences that we had recently. He's formerly with Ernst & Young. And as I said, he's a nationally recognized tax planner. And since we're coming into the end of the year, I thought it would be a good idea to touch on some topics that maybe you could get in front of. And if you need to follow up, you can go directly to Michael. He's available to anybody out there. Michael resides in Los Angeles. You should know that he also was a highly recognized collegiate basketball player. He's 6 feet 10 inches tall. And somebody that you would have as an advocate for you on the tax side. Very impressive gentleman. Michael, are you available?
Tom, I think he just stepped off. He'll be right back.
Okay. Well, one of the reasons why we had Michael on the call was we started talking about how to plan for the year end in the advanced planning area. And the advanced planning area became prevalent when my father's health was deteriorating, and how we would get in place the plan that would assist not only my father Carl, but his wife Nancy in with the responsibility of what happens next. And it's an overwhelming, chaotic process. And you can imagine the emotions behind it. But when you meet this time in your life, you want to have a plan in place. And Michael and I were talking about that and making sure that all of our institutional partners, as well as our private clients, know that they could come and get very high level advice and planning structure with the assistance of strategy asset managers and your advisor out there. Joe, as he popped back on, I can't see my monitor.
Not right now, but we also just want to go over some year-end planning dates that everyone should be aware of.
Excellent.
A lot has been talked about tax loss harvesting. And again, this just helps to make sure that you don't have a big capital gain and making sure you sell some of the positions. You can contact us or your advisor. Also, required minimum distributions. We'd like to get these done sooner the better, but if you can also reach out to us, make sure that December 31st is actually the weekend. So Friday, December 30th is the last date. And again, some of the custodians we work with, they're actually requesting any processing or record keeping for tax year 2022. They just would have it submitted by the end of November, actually December 2nd. So just some talking points and dates to remember as we head into the end of the year.
Okay, that's a good reminder. I think he needs a little bit more time, so we're gonna go back to Bill Lang and Adam. Are you still on the call?
Yeah,
Still
we're
here,
still,
yes.
still here,
Okay,
Tom.
great. A little bit more airtime on your side of things
Great.
for how do they contact you, Bill? What's the next step with getting more information
Yeah.
for those people who are on the call?
So if anyone would like more information or just talk further, get a better understanding of what we do, you can contact me directly, certainly at wlang@worldclinic.com, WLANG, worldclinic.com is all one word, or Adam at abritton at worldclinic.com. The website is www.worldclinic.com. And then we also have our growth and development officer, vice president of the company, Alexa Carlin, and that's A Carlin, ACARLIN at worldclinic.com.
Great. We will make sure that we blast that out to our partners out there, clients, both institutional and private client, so that you can follow up as needed. And Michael Williams just popped back on the call, Bill and Adam. So
Great.
I'm going to shift back. So
Terrific.
thanks for
Tom.
filling in that time there. Michael, are you there?
I am. Sorry
Would
about that, guys.
That's okay. That's okay. I also need bathroom breaks every now and then, at the wrong time. So would you please introduce yourself, Michael, and to the crowd?
Sure. Michael Williams. I am a California licensed tax attorney. I live in Los Angeles. Focus my firm's practice on tax credits and tax planning. So what that means is that when a business is operating, we try to work with entrepreneurs to help their companies obtain tax credits at the federal, state, and local level. And then when they are looking to exit a business, we try to help them do it in the most tax efficient manner to try to mitigate both federal and state income tax exposure for those sales. So that's a really quick 30-second who I am.
Michael, when we were together a few weeks ago, you threw up a slide that was relevant towards individuals and as well as to to corporations. But as we go into the end of the year with some of the dates that are important for you, what are you seeing some of the people coming to you directly for right now, leading into the end of the year?
Yeah, it's a great question. I think there's always uncertainty at the end of the year, which programs are going to get renewed, and what the tax implications are going to be for next year. So this time last year, there was a lot of speculation that the Biden administration was going to make a big move to modify provisions in the tax code, specifically around capital gains. So we saw a lot of deal activity from an M&A perspective occur to try to beat the end of the year. Some similarity, not quite as intense this year, but we are seeing some similarity just because of the way recent elections have occurred. There was some thought that perhaps additional changes could occur next calendar year that people want to make sure that they try to mitigate this year. There's also some expiring programs. The employee retention tax credit is one where there's some not super imminent, but somewhat imminent deadlines for that particular program. And then again, others that where there are timelines where towards, if you miss the end of the calendar year, you're prohibited from filing prior year refund claims on amended returns. So end of the year is always pretty important, just to make sure that if you are filing, for example, an amended, R&D, research and development tax credit, that you're meeting the timeline so you can capture as much of that funding as possible.
Okay, great. Adam, how do people contact you directly?
Oh, sure. You can you can email me, michael@cfomw.com, or you can just visit the website and there's a little widget that you can contact me. But the email is usually the best. So it's Michael@C as in Charlie, F as in Frank, O as in Ohio, M as in Michael, W as in Williams.com.
Okay, we'll make sure that everybody gets Michael's contact information after the call. Michael, is there anything kind of in parting that you would say to an individual who's on the phone right now, and then switch over to the corporate side of things?
Yeah, so from an individual perspective, the more time that someone like me has to work on an exit, the more that we can do from either a reorganization or structuring or planning perspective. So, sometimes clients will come to me and they say, I'm selling my business, I want to save taxes. And my question is, when's your close date? And they say tomorrow. That's not really a great solution. If they say 3 months from now, 6 months from now, a year from now, those are much better conversations. There's a lot more you can do. So that's from an individual perspective. The more time an entrepreneur can give for lead time, the better. And from a corporate perspective, it's one of those things where there's so many tax. I kind of define the tax code as a set of incentives. So from a personal perspective, the government wants you to own a house, so they let you write off your mortgage interest, that sort of thing. They do very similar things from a corporate perspective. They want high skilled labor, so they provide credits for technology companies, for manufacturing companies, for high level services companies. There's a lot out there, depending on the nature of an entrepreneur's business, and so few companies leverage those tax credits to their advantage, and they should be doing so.
That's a great point. So few, take advantage of these tax credits that are out there. Very important to repeat. We talked about tax loss harvesting and the letter that we send out to private clients, to our advisors, as well as to the clients. And just as a reminder, November 15th or November 16th today, we have a month and a half left until the end of the year. And this is the time that you want to go in and take a look and talk to your team, your tax team, as well as your advisory team about tax loss harvesting, lowering your capital gains by selling positions that don't have gains, and then realize those losses to harvest and also mitigate your taxes. So pay attention to that right now and make sure you're in communication with your team, your advisory team, and your tax team for the year end. You don't want to do this in December. There's a 30-day rule that you want to adhere to, 31 days, and that takes place with, I would say that the very bare minimum would be to go into the end of November to give your advisor and the team plenty of time to book the losses, and then also to keep you invested if that's the case. RMDs, we talked about that, required minimum distributions. take those RMDs and make sure you're talking to your team about that. And then you heard about the dates from Joe Traba. We want to remind you again about the tax dates. The December 30th IRS deadline, December 31st falls on a weekend. Therefore, December 30th will be the last day for year-end processing. And all these time-sensitive requests must be processed and recorded for tax year 2022 by being submitted in good order by Friday, December 2nd. So there's that deadline date, Friday, December 2nd, for some of those requests. Joe, do you have any comments before we sum up? First of all, let me thank Michael Williams for being on the call, and we'll make sure that we pass along Michael's information over to you. And then also Dr. Bill Lang and Dr. Adam Britton, thank you again for being on the call. I don't see any questions that we have coming up in queue. But Joe, do you have any comments to make before we sign off?
This has kind of been one of our longer calls, but we thought it was important so everyone can hear having a financial plan. This is the efficient use of your time. And we really are here to help you live the life that you want to and protect what matters most. And like we've said here, most important thing in your life is your health and well-being. We always have this mantra here, stay positive and active. And that's what we hope everyone's doing as we head into the holiday season. And really thank you for your time today.
Yep, we thank everybody. We'll just open up. Does anybody have any questions? They want to go off the mic, and this is one of the benefits of being on this call here today. If you'd like to chime in, if not, we'll cut off in 30 seconds. I don't see anything happening, so I think we'll just go ahead and conclude today's call, and we will be back in touch in December for just a follow-up call. And if you have any questions, please reach out to your advisor or also contact us directly so we can all work together to have a positive year end, and then make sure that we're all on the same page with going into 2023 and what the objectives are for you and your holdings. Thank you, everybody, and have a happy Thanksgiving.